Hey there, I'm Bobby Jones, a retired CRNA turned apartment investor and founder of On Call Capital. I've often been asked how the pandemic has affected my investments in multifamily, and most of the time, my response goes something like this. I've seen little to no disruption in my passive investments. My lowest occupancy rate in any building was around 82%, which is well above the 65 to 70% break even threshold of most syndications. The operators I work with care about their residents and work with them on payment plans and incentives for on time or partial payments. The properties performed well throughout the pandemic because when you invest with great operators in great markets, you are seldom disappointed. And all of that is true. But there are some changes happening in multifamily that are just taking a little bit longer of a time to show up. So I figured I'd put my thoughts into a video so that you can get a better feel for where I think things are headed. So cap rates are compressing. Now, if you'd like a more in-depth explanation of cap rates, check out my video on the topic. But suffice it to say, cap rate compression is a sign that properties are getting more expensive to purchase. There are more syndicators in the game now, and it's not like the number of apartments is going up at a rapid rate, particularly for workforce housing. This demand is driving the price of commercial property skyward, making solid returns harder to come by. A lot of properties are being sold right now as a result because experienced teams are capitalizing on this hot market for their own investors. There's also a lot of institutional or stock market money and overseas money coming in. These investors don't require the outsized returns that many apartment investors have become accustomed to getting, since they come from more volatile or negative interest rate markets. Again, this influx of money looking for places to buy only serves to heat up the market. Now, inflation is rising, and so are rental rates. There are several reasons that we are seeing inflation rise. Many will point to the increased money supply and say, duh. But the truth behind it is much more nuanced than that. Specifically in apartments, rents are going up in many markets because there is more demand to live there than existing workforce housing. And let's be clear, consistently raising rental rates in good markets are a big reason why multifamily investing remains so lucrative, even though purchase prices are currently rising. But this consistency is part of the reason why many operators write in high rental hikes over the life of an apartment investment. And I would caution that rental hikes should be related to actual improvements in the property and catching up with the surrounding rental market more so than trying to be at the top of a market. In addition, some of the most attractive mortgage rates in decades are fueling a boom in home building, which is a key engine of economic growth. And while we are still behind in many markets, increased building could slow down rental rates eventually. Sure, there are some markets that will continue to boom. Certain demographic and economic shifts don't reverse overnight, but it's just something else to keep an eye on. Inflation on building and renovation supplies are tied to supply chain and distribution issues across the country. For the last several years, we've seen syndicators focus on building new Class A apartments. All things being equal, construction costs are similar for Class A and B. So why not throw in a few swanky amenities that don't cost much and charge higher rents as a result? You get a higher return on your investment, meaning you pay your investors higher returns at a faster rate. Now, more eyes means fewer deals. With more attention being paid to multifamily investing, it was only a matter of time before deals started really getting snatched up. Most operators are looking in the 75 to 200 unit range, meaning that many of those size apartment buildings are now going through their second or even third owner turnover. There are fewer mom and pop owners in this particular space right now, meaning that there's just less meat on the bone for folks to come in and clean up operations. This is translating into smaller returns in this space. But let's be clear though, these returns, while far from the days of 25% annual returns, are still quite stable in the 11 to 15% range. There's also room in smaller deals in the 20 to 50 unit range. These deals get less of a look from institutional investors because they're just too small from a capital raise standpoint. These are properties that are often still mom and pop owned, and that can make them easily turned over for a nifty profit. But these are not deals that most syndicators utilize passive investors for due to their small size. Now, There are shifting return profiles that we need to keep an eye on as well. When I first got involved with apartment syndications, the focus for me was on cash flow. Now there are still deals out there that provide plenty of cash flow, or at least the option to emphasize your cash flow over some of your overall returns. But for the most part, those return profiles are shifting. What I see more of today is a delay of cash distributions from where it was, which was around the 6-month range, all the way out to the 12-month range now. The distributions are still 6 to 8% on average for the offering, but they're more heavily weighted to the back end. For example, a 6% distribution may give you nothing in year one, 3% in year two, 8 to 10% in years 3 to 5 to average it all out. There are a couple of reasons for this. There's just more uncertainty in the market with COVID-19 still raging and the eviction moratorium still in flux. There are also more contingencies that must be made regarding building materials. These products are simply higher priced now, which means that it takes longer to recoup some of those profits. Delays in distribution have led to delays in renovations, and syndicators must take these delays into account when building a realistic return profile for investors. So what you see now are investments that wait a year to start paying you, and then they still don't pay as much in the second year out of caution. While I personally don't enjoy this very much, it's actually good conservative underwriting that you want to see. Now, moving on to the fund model. One thing that is becoming more popular in the space is a variety of fund models instead of standard syndications. Some funds, such as a single purpose vehicle or SPV, exist to invest in a single asset. Others exist to invest in multiple assets over a longer time period, such as 10 years. Suffice it to say, there are many different fund models in use, and I can't possibly explain them all here. But many of the operators I work with are using fund models right now, or at least looking into them heavily for the future. In summary, what I'm seeing for passive investors is an environment that is changing. Real estate tends to change slowly, so it's no surprise that we are just now seeing some of these trends after a year and a half of the pandemic. Some of the best deals you found as a result of the 2008 financial crisis were in 2011 and 2012. It's important to note that apartment investments remain one of the least volatile and safest places to get high returns on your capital. My mantra hasn't changed. Investing with great operators in great markets is the most surefire way to build your wealth in multifamily investing. I hope you enjoyed this short look into the changes going on in multifamily. If you have questions or comments, pop them in the comments section below. You can also find me on Facebook, LinkedIn, or Instagram, or visit my website at www.oncallinvestments.com. Thanks for watching, and I'll see you on the next video.